Top 10 mistakes new investors make and how to avoid them. Investing can be a powerful tool for building wealth and securing financial freedom, but for beginners, the journey can be riddled with pitfalls. The world of stocks, mutual funds, real estate, and cryptocurrencies offers great potential, but without the right knowledge and mindset, new investors often fall into traps that can erode their capital and confidence. These mistakes are usually avoidable, yet they are common due to lack of experience, education, or discipline. Whether it's chasing hype, failing to diversify, or letting emotions drive decisions, missteps can have long-lasting consequences. 1. Chasing hot tips and hype. One of the most common mistakes new investors make is falling for stock tips and market hype. Whether it's a friend's recommendation, a viral post on social media, or a sensational news headline, these sources often create unrealistic expectations. Many of these tips are driven by speculation rather than sound financial analysis. Acting on hype can lead to buying overvalued stocks that crash once the excitement fades. This strategy is not only risky but unsustainable. Instead of building wealth, investors may end up with substantial losses and disillusionment. Moreover, these hot investments often lack fundamental value and can become traps when markets correct. Emotional decisions based on fear of missing out, FOMO, also contribute to this mistake. It's essential to understand the difference between speculation and investing, and to remain grounded in research and logic. 2. Timing the market instead of time in the market. Many novice investors attempt to time the market, buying when they believe prices are low and selling at highs. While this sounds logical, in practice it's nearly impossible to do consistently. Even experienced professionals struggle to predict short-term market movements. Trying to time the market often results in missed opportunities and underperformance. This approach is rooted in short-term thinking and often leads to emotional decisions during periods of volatility. Instead, successful investors understand the value of compounding and the power of staying invested over time. Long-term investing allows you to ride out market fluctuations and benefit from overall market growth. The attempt to buy low, sell high seems smart but usually ends with investors doing the opposite, buying high on emotion and selling low out of fear. 3. Lack of diversification. Putting all your money into one stock or a single asset class is a high-risk move. Many new investors make this mistake believing in the extraordinary potential of a single company or trend. While it's true that concentrated bets can yield big returns, they can also lead to devastating losses if that investment fails. A lack of diversification increases exposure to risk and can lead to large drawdowns during market corrections or economic downturns. Diversification spreads your investments across multiple assets, reducing the impact of a poor performer. Think of your portfolio as a garden. It flourishes when you plant a variety of seeds. A diversified portfolio is more stable, resilient, and better equipped to weather volatility in any one area of the market. 4. Ignoring investment fees. New investors often overlook the impact of fees, assuming they are too small to matter. But over time, fees can significantly erode investment returns. Whether it's brokerage commissions, mutual fund expense ratios, or hidden management fees, these costs add up. A difference of just 1% in annual fees can result in thousands of dollars lost over decades. High-fee investments can quietly diminish the power of compounding and reduce your financial gains. Unfortunately, many investors don't notice these fees until they look closely at their account statements. 5. Not having a clear investment goal. Investing without a clear goal is like sailing without a destination. Many new investors jump into the market without knowing what they want to achieve: retirement savings, a house down payment, or wealth accumulation. Without defined goals, it becomes difficult to measure progress or choose the right investment strategy. Goals determine your risk tolerance, time horizon, and asset allocation. Without them, you may invest too aggressively or too conservatively, missing out on optimal results. Goals provide structure and motivation, guiding you through market ups and downs. 6. Letting emotions drive decisions. Investing decisions driven by fear, greed, or excitement can be disastrous. Emotional investing often leads to buying high during market booms and selling low during panics. It's a major reason why individual investors underperform the market. Humans are wired to avoid pain and seek pleasure, but these instincts are often harmful in investing. Fear can paralyze action during downturns, while greed can drive irrational exuberance. Emotional cycles cause market bubbles and crashes, and inexperienced investors get caught in the whirlwind. 7. Not understanding what you're investing in. Investing in companies, funds, or assets you don't understand is like gambling with blindfolds on. Many new investors buy into complex financial products, cryptocurrency tokens, or volatile stocks without fully understanding how they work. This lack of knowledge increases risk and leads to poor decisions. If you can't explain how a business makes money or what factors affect its value, you probably shouldn't invest in it. The more informed you are, the more confident and rational your decisions will be. 8. Being impatient. Building wealth through investing is a marathon, not a sprint. New investors often expect quick returns and become frustrated when results take time. This impatience leads to abandoning good investments too early or chasing high-risk opportunities promising fast profits. The truth is, compounding takes time, and successful investing rewards patience. Short-term thinking creates stress and often causes poor decisions. Historical data shows that markets reward long-term investors who stay consistent and disciplined. 9. Trying to do it all alone. Many beginners assume they must navigate investing entirely on their own, which can lead to costly mistakes. While independence is commendable, investing involves complex concepts like tax strategies, asset allocation, and retirement planning. Without proper guidance, it's easy to overlook key elements. Books and online forums help, but personalized advice can make a big difference. Whether it's a mentor, financial advisor, or robo-advisor, getting guidance ensures your strategy aligns with your goals and risk tolerance. 10. Neglecting to rebalance or review the portfolio. Many new investors set and forget their portfolios, failing to revisit or adjust them over time. As market conditions change, your asset allocation can drift, increasing risk or misaligning with your goals. Without rebalancing, your portfolio may become overexposed to certain sectors or asset classes. Reviewing your investments helps ensure they still meet your needs and respond to evolving circumstances. Life events like job changes, marriage, or economic shifts should also trigger a portfolio review. If you enjoyed this video, give it a thumbs up and subscribe for more content. Hit the notification bell to stay updated with our latest videos. Share your thoughts in the comments below. Thank you for watching.